Chris Wolfe is Chief Investment Officer at Merrill Lynch Private Banking and Investment Group. He helps manage, get this, $157 billion in assets. Maybe even some of those assets are yours. Chris, good to have you on the show.
Thanks, Al.
I got to ask you, though, on a day when Dow is down 250 points, how do you protect $157 billion?
Well, I think the easy answer would be to say we've already gone into this period being very cautious. I think the harder answer is, I think for clients that are looking at this environment dominated, as you talked about earlier, about the headlines, the politics, the news from Europe and Washington, it's all about ensuring that what they own is consistent with their objectives. And that may mean owning a lot less equities, more cash, more gold, and different types of investments that they may not be thinking about, from their days in the 90s and early 2000s when they really had this asset allocation long term and it's all going to be fine. And I think what we found is that the political environment has really thrown a wrench into that thinking.
So it's client by client.
Yeah, that is largely how we do it. But we start with models and kind of base cases, and those cases are somewhat defensive in this environment.
All right, Lisa and I were just talking. All right, markets held hostage by headlines.
Yeah.
When do we break this cycle of positive headline, market up 200, negative headline, market down 200? When does that break?
So our view is that this is a good news, bad news answer. So the good news is that it's relatively soon. The bad news is it's going to take elections in 20-some-odd countries next year to break the headlines, because that's when we see political regime change. We have elections in the U.S. We had snap elections in Italy and Greece. We have to have them ratified, but we're going to have France. We're going to have a number of countries next year that will help reset how political influence drives capital markets.
All right, so stay tuned. 2012 should be a better year, according to Chris Wolfe. But Chris, let's go big now and talk about asset allocation. You talked about how every portfolio is different for investors, but one thing I noticed was you had a pretty high allocation to alternative investments, and certainly some of these managers have done well in this particular environment, but I was hoping you could drill down a little bit into what types of alternatives.
Yep. So broadly, we talk to clients that can qualify at about 30% of their portfolios in things that don't follow the traditional markets, more manager risk. That includes things like real assets, so things like real estate, includes private equity, and includes hedge funds where it's appropriate. It also includes a lot of commodities, and so that's part of our real asset allocation. So you can think about that 30% being divided roughly in threes is a good way to think about it. That's our starting point. We'll customize to clients depending on their liquidity risks and their views on, say, hedge funds or commodities. They may own land or rental properties on their own. But I think for very high-end clients, that starting point, because they can take some of that illiquidity risk, they can be the bank, really, is an important component of the discussion.
And how much is income part of the discussion? People want ratable income every month.
Well, that has changed dramatically over the last 12 months. It has become much more of a focus in the fixed income as well as in the equity portion, trying to drive more income out of those portfolios.
Not easy.
Well, we're all in the same trade, right? The dividend story, we're into the credit story, global fixed income, mostly Asia focused. But what we found is more opportunities and alternatives. We found that many managers being more willing to distribute income to their clients or to their investors on a monthly basis, because that's the trend, is to get more income, more flexibility to deal with this topsy-turvy environment.
What sort of liquid or investable assets are we talking about to have that high an allocation to alternative investments?
I think about it as a couple ways. It doesn't mean that all alternatives are illiquid, right? So commodities, for example, traded every day. Currencies traded every day. And the managers or strategies that we use have fairly high liquidity, daily in many cases. We also think about real estate as having a public and a private component. REITs are a public version. Private real estate, everything from ranch land to apartment buildings, is the private side. Private equity is really where it starts to get more illiquid. And what we found is many hedge funds have changed some of their terms. They're not locked up for 3 years and wait. There's more liquidity in this space. Not as much as we'd like, so we're still careful there, but more than we've seen in the past.
Should we ask them about a shopping list?
Yes, let's go shopping.
We love to shop here. I don't know if you saw Lisa in the Harry Winston diamonds earlier, but let's talk about
what's the borrow list.
Yeah, big time borrow. Let's talk about your shopping list. All right, refiners, China equities, global equities. Walk us through each of these.
Well, I think in terms of being conservatively positioned, we get clients that have heard that message from us for a long time, and they're looking for where are the opportunities, where's the puck going to be, to use a hockey analogy. And we're thinking counter-cyclically. So refiners are one example where the margins in this business have really come off the boil, and we're looking at a lot of people saying, oh, they're terrible, they're going to miss earnings, et cetera. But this is exactly the time when you want to look at them, when a lot of the bad news is priced in. Is oil demand really going away, gasoline, et cetera, over the next couple of years? We don't think so. So that's a place to look. Second, a little bit more risky, is Chinese companies, right? We're talking about a recession, a hard landing, and a lot of bad news priced in. They've been one of the worst performing stock markets over the last few years. Now, there's probably more pain in the banking system, but again, you want to look for the opportunities where there's a little bit of trouble and say, where where is the right valuation for this? Not there yet on Chinese equities, but a place we might want to go.
What sectors, though? I mean, when I think about a lot of the Chinese stocks that are listed abroad, right, there's that muddy waters factor now that there's not a lot of transparency there. So what type of sectors offer the most transparency?
So at least if you're talking about Chinese equities, and we think about doing on-the-ground research, we have people in the region that help us with that. But it's some of the infrastructure story. We don't see the investment really slowing down there. Some of the ports, some of the railways, although that's been a little bit more dicey recently. And in fact, switching to the higher quality banks is something that our research analysts have highlighted recently as well. Lower quality likely to suffer with some of the financing problems that we'll see over there.
All right, let's talk a little bit. You know, we just had Jack Ablin on, who's Chief Investment Officer of BMO Harris Private Bank. And he was talking about where stocks are trading now, basically discounting a 50% lower earnings forecast for next year. And he was saying that's way too bearish. Do you agree with that? Or do you think, like Hewlett-Packard, we're going to start to see forecasts for next year really come down quite a bit?
I think a couple of things are happening. One is we're at a peak in the profit margin cycle, so there is naturally likely to be some revision downward to earnings growth next year. Second is I think there's a big disconnect in the way that you value the equity markets. Many people are focused on the price-earnings multiple and earnings and saying it's all about growth. But balance sheets are actually kind of expensive in the U.S. So the reality is that if you look at the way you have to replace assets, it's actually markets aren't all that cheap. They're fairly valued. The measure is called Tobin's Q, which is, I think, something that's important to look at. You look at a multiple of measures. So if you're just
if you had to replace all your plant and equipment at today's prices, you're saying that stocks are what?
Fairly valued on that basis. You know, it's not like they're exceedingly cheap, meaning the market's not pricing the balance sheets at a super cheap level. It's pricing growth at a cheap level, but it should, because there's political interference, I guess, in the process, and determining whether or not the policies in place will allow us to generate that growth. HP already suggesting that growth next year, and we've talked about the margin story being at a peak, is going to be lower. So stock market's pricing in some of this.
Well, let's talk about then applied Tobin's Q, getting into the weeds here. I'll use that expression. Over to international equities and Chinese equities. We covered Chinese equities. What around the world do you look at now? Is Europe, for instance, undervalued based on that metric?
You know, the big question is whether or not European financials are. So broadly speaking, the European exporters, some of the Swiss exporters, for example, are. But I think the challenge is that European indexes have a lot of the financials in them, and we're not sure where European banks specifically are going to end up after what will be a restructuring of the European financial system, you know, on the back of whether the ECB prints or not over the course of the next 6 or 12 months. Bottom line is, no, not clearly cheap, because there's event risk. And we just don't know what the politicians are going to be doing over the next 6 or 12 months.
So where do you wait it out? U.S. Treasuries?
Well, our focus right now has been clearly on the U.S. It's been an outperformer over the last 18 months, but we're coming to a period where the end of that strength may be upon us as the elections that we talked about earlier come to pass next year. And our view is that the shopping list that we'd want to include, we talked about Chinese stocks earlier, is also international. I think, you know, we've focused this on a paper, New World, New Order, New Rules, New Order is a way to highlight international investing. If the world becomes more driven by regional powers, then part of the solution for investors is to go to those regions where they may be getting support from their local policymakers, their local banks. Even though we focused in the past on the big multinationals benefiting, in the world of the future, it may be that the smaller regional companies do better. And the thing that clients don't want to do, which is invest internationally, is the thing that we're going to start telling them more about over the course of the next 12 months.
Would that include a Brazil as an example?
It would, although we have high inflation, high taxes, and we have a central bank, though, that started to figure this out. They've got to do something, starting to cut rates to actually spur growth. So that kind of policy change, which is lower rates as inflation cools globally, is actually not a bad thing for thinking more internationally, where valuations, by the way, cheaper than they are in the U.S.
What regions are attractive?
We like Asia. It's an area that we focused on for the last 12, 18 months. It's been a difficult call. The economic activity index led by China has really come under pressure. Markets have clearly underperformed. So a long U.S. and a long Asia is actually kind of washed out in the middle. But I think the focus over the next 6 or 12 months is really going to be on the growth that can be driven by lower rates in China.
Can you get the scale? You've got $157 billion to find a home for. Can you get the scale in a place like Vietnam or Indonesia, et cetera?
No, those become much more of an opportunistic play. I do think Indonesia, broadly speaking, is cheap. It's mostly driven by the minerals and mining companies that look relatively attractive. Our analysts have highlighted this, but we can't put a lot of capital there. It becomes part of a broader allocation to, say, Asian markets, both on the credit and the equity side.
Credit and the equity side. All right, we got to leave it there, Chris. We covered a lot of ground. Globally, quite literally speaking. All right, that was Christopher Wolfe, Chief Investment Officer of Merrill Lynch Private Bank. Okay.